Good morning and welcome to this event, NEC Pricing Options, Lump Sum Remeasurement, Target Management or Cost Plus. This is the fourth in our series of webinars and events looking at the effective use of NEC contracts. My name is Tim Willis. I'm a Senior Associate at Irwin Mitchell in our construction team. We are a team of 14 based all over the UK, and we carry out a broad range of work. Next slide, please. We advise clients on all kinds of matters, whether they're developers, contractors, subcontractors, funders, or in the case of some of the more difficult problems, insolvency practitioners, and all aspects relating to construction and engineering work. Our support is practical and commercial, and as a team we have extensive knowledge of the construction sector, and so we deal with all aspects of the construction sector, from procurement strategies through to the contract documentation, advising and assisting on projects, dealing with construction and engineering disputes if those arise. And in the current market too, building safety is a significant part of that sector. We're heavily involved in that, both in terms of advising on remediation contracts and strategies around that, as well as dealing with the recoveries through the supply chain through the various measures under the Building Safety Act. We're also involved in some significant insolvency work in the construction sector, and so you can see we have a very broad range of experience. Next slide, please. So I said this is the fourth of our series. We're holding this series of events across this year, which considers the NEC contracts. And in these, we're concentrating on the engineering construction contract, but many of the principles that apply to that contract also apply across the family. And details of the series can be found on the hub page, which shows the series in full. Our next event will be on the 18th of June. Next slide, please. So today we're looking at the question of pricing options, and pricing options is a major factor in any contract, any procurement. How are you going to manage pricing risk? And the NEC contracts use a mechanism called the main payment options to give a broad range of pricing solutions. And these are standard solutions which the client then has to adopt. And so we'll be looking at those options, what's available, and the challenges around the selection of options, and also responsibilities around the preparation and use of the pricing documents. And it's important that both the client and the client team understand the options, but also it's critical too for the supply chain to understand what obligations they are pricing and what it is that they're undertaking under these different options. Next slide, please. So how do the main options work? So the main options are a common structure in the family of contracts. And the family includes term contracts, professional services contracts, supply contracts, and also works contracts. And it also has complex contracts, or what are called the short form versions of the contracts. And for the more complex projects, we use the complex structure contracts, which are often referred to as the full contract. This family includes professional services contract, the term service contract, engineering construction contract. And for the more complicated contracts, there are payment options which allow us to choose a particular payment choice. And the structure then is that all of the contracts have this structure. They have core clauses, main payment option clauses, then options for resolving and avoiding disputes, and secondary options. And the client has to choose at the point of procurement, one main payment option, and that decides your payment option for that project. The main payment options available differ slightly between the terms of the contracts you're using. So the professional services contract has slightly different main payment options to the works contract. And today we will be focusing on the works contract, but the way that this works is similar across the family. Next slide, please. So the main payment options available for the works contract are option A, a price contract based on an activity schedule, option B, a price contract based on a bit of quantities, option C, a target contract based on an activity schedule, option D, a target contract based on a bit of quantities, option E, a cost reimbursable contract, and option F, a management contract. So how does the contract drafting introduce this choice into the structure? So each payment option is a standalone set of clauses which you incorporate into the contract by identifying which option you wish to be part of the contract, and you identify that in the contract data part 1. Section 1 of that will identify the conditions of contract and the main payment option. And if you didn't make a selection, that would make it very complicated to understand whether or not you had a workable contract or not. So it's important that that is correctly done. But once that is done, then that incorporates the drafting into the contract. And the structure of the drafting follows the structure of the rest of the contract. So the contract's a structure of core clauses in 9 sections. Section 5 of the contract always refers to payment. And so when you choose a main payment option clause, what that will do will introduce new drafting that dovetails with section 5. But it also dovetails with the other sections of the contract where that's relevant. For example, if there were additional compensation events around that payment option, then there will be some clauses dealing with that as well, as we'll see when we look at this in a bit more detail. Next slide, please. The way in which the contract works then is that it uses a definition. Next slide, please. The contract uses a definition, the price for work done to date, as the definition in the core clauses in the payment section. But then what it does is it changes what we mean by that, depending upon the payment option we've chosen. So that, in fact, what we pay in a monthly payment cycle will depend upon the payment option chosen. For option A, what we're paying is based on the activity schedule, and we're paying the prices for activities which have been completed in that payment cycle. In option B, we're paying for the quantity of work that has been carried out in that payment cycle, and that creates a remeasurement structure. And so it's the quantities measured or proportions of lump sums if the bill of quantities has got lump sum items in it. In the other options, so C and D are the target contracts, and option E is the cost reimbursable contract, option F is the management contract. Those all use a definition of defined cost as the basis for what we're going to pay. It's the defined cost that we assess what we would be paying before the next assessment date. So it keeps the contractor cash flow positive, looks at what the contractor will have paid at the next assessment date so we're basically valuing a month in advance. New slide, please. Next slide, please. So the documents use then these definitions, and when we're talking about paying against a price document or other places where the documents use the definition of prices, then we are again given a series of definitions. So in the lump sum contract, A and C, so option A and the target contract option C, where our price or our target was set by the activity schedule. We understand that because it says the prices are the lump sum prices for each of the activities in the schedule, unless later changed in accordance with this contract. So both the price originally priced and the target originally priced will be what's payable as a price, unless that's later adjusted. Now, there's the target contracts are more complicated than that, as I'll explain shortly. Again, in options B and D, we've got a definition of the prices, and there the prices are referencing the bill of quantities, and it's the amounts obtained in the remeasurement of the quantities or the lump sums in the bill of quantities once those have been carried out. And again, that bill of quantities prices can be adjusted through the compensation event mechanism. Options E and F are different in the sense that we don't have strictly what we would call a pricing document. There is in option E a definition of the prices, but that is a forecast of the resources that we consider we will use in the course of carrying out the works. And in option F, again, we don't have a simple pricing document. We have a slightly different structure. Next slide, please. So in options C to E, when we're talking about the resources, paying the resources which the contractor is going to be using, what we're talking about then is defined cost. And what we mean by that are the components in the schedule of cost components, which is a standard document which sets out a series of headings under which types of resource can be captured. And we'll look at that in a little bit more detail. But we also consider disallowed costs, which are costs which would, on the face of it, be recoverable, but then, according to the definition of disallowed costs, are taken out of the account. In the option F contracts, then we don't have a schedule of cost components, and we don't have a full pricing document. What we do is we separate an element of defined cost is going to be work which has been priced, and an element of work which is simply what the contractor is paying to the subcontractors. And we've also got the definition of disallowed costs, and we'll look at that in more detail. Next slide, please. Next slide, please. Sorry, actually, can we go back one slide? That's it, thank you. So the schedule of cost components is a standard structure, which is just part of the printed contract or the digital version of the contract, if you buy it that way. And the schedule of cost components, as I mentioned, sets out a series of headings. The terminology is peculiar to NEC, but what essentially it covers is people as it sounds. It is those things in terms of people who are employed by the contractor who are carrying out work. Equipment is anything the contractor's using to provide the works, but not included in the permanent work. And so that could be anything from a tunnel boring machine to drill bits or items for an office or scaffolding or generally, construction plant as we understand it, cranes and so on, very broad definition. Plant and materials are both things going to be incorporated into the permanent works. Plant is something that's manufactured and procured, not necessarily specifically for our project, but used in our project, and materials is, as it sounds, it's simply materials. Subcontractors are people who, pursuant to a subcontract, have an obligation to carry out and complete work. Labour-only arrangements are dealt with under the people heading rather than as subcontractors. Charges is a list of different kinds of charges which a contractor might incur in the course of carrying out construction. and manufacture and fabrication outside of working areas and design outside of working areas are dealt with as a separate cost centre. And then finally, we've got insurance, but that's always a deduction of sums rather than the recovery of sums. And the general position is then that the contractor has to understand what of its resources and its supply chain it will recover under the components in the schedules of cost components, and anything else which it's going to incur as a cost or any element of profit that it wants over and above anything included in, if there were any rates used in other components, that needs to be allowed for in the fee. So the fee doesn't have a definition as such, but it just covers the contractor for anything which the contractor needs to recover to put it commercially in a position it needs to be in, apart from the things which it's recovering through the cost components. So sometimes we talk about two buckets. A defined cost it is in one bucket. It's the bucket you recover your components from, all of those items listed there, and then the other bucket is the fee, and you just apply the fee to the defined cost to give you your what your total recovery will be. The fee is at the tender stage, just tendered by the contractor, so it is subject to competition pressure, but otherwise it's whatever the contractor sets as that. Now, next slide, please. So we mentioned then that in this context, we're talking about recovery of resources. And so the other aspect about the target contracts and the cost reimbursable contracts, and to some extent the option F contract, is we double check whether or not actually the resources which the contractor is seeking payment for should be paid. The slide gives a very truncated examples of what's in the definitions. The definitions are a bit longer, but things to take account of then is firstly, if the contractor is unable to justify by records that the resource has been used or how it's been paid for, then that's going to be problematic and could mean that cost which is applied for is disallowed. The payments to subcontractors have to be in accordance with the subcontract. So again, a project manager will be considering whether or not that stacks up what's being paid to the subcontractor and the terms of the subcontract. There are also links to aspects of how the contractor is performing its work. So they must always justify that the resource has been used in order to provide the works. There is allowance made for reasonable wastage and reasonable utilisation, but because the NEC contract manages risk, one of the significant items of disallowed cost is that if the contractor's failed to manage risk by not giving early warnings, then costs associated with that risk can be disallowed if the client could say, well, had we been made aware of that risk, we could have avoided that defined cost. Another aspect which is subject to quite a lot of debate is correcting defects. So disallowed cost is correcting defects after completion. You'll note the word after. So correcting defects before completion is not disallowed cost, although it may have commercial implications for a contractor. And the position is subject to some debate. Obviously, there's a level of defects which the industry accepts is part of the construction process, but what if the contractor is actually producing work with a very high level of defects in it? Should that still be allowable, the resources around that? To some extent, that might get managed out in the subcontracts, i.e. if you're not paying the subcontractors to correct defects, then that's not coming to the client. But you do see some clients correcting these definitions to try and impact upon incentivizing contractors to manage defects more efficiently. One example I heard of recently was where the fee was adjusted where the level of defects went above a certain threshold. The detail is always the important thing, how you measure these things and how you capture these things. So the option F contract, that's looking at two sides to the account, really. One part is the payments made to the subcontractors, and the other part is the payments made to the contractor. But there's another aspect of the account. There's still the fee. And essentially what the contractor has to do is it's got to cover the costs of managing all of these processes within the fee, unless it's specifically got that into its pricing. And so there's two aspects to disallowed cost here. One is a contractor can't try to recover through subcontract work which it's priced, so it can't be paid for prices and the subcontractor doing the work. That would be double recovery. And also it can't recover through defined cost work, which should be just the management of the contract work, and that should have been covered in the contractor's fee. Now, we'll talk about option F a bit more, but it's a slightly complicated contract, and there's more to be said about that. Next slide, please. So all of the options then contain some kind of pricing risk for the contractor, but depending on the option chosen, the pricing risk may be shared or significantly reduced. Even the most onerous pricing options leave considerable risk that the contractor does not price or program, and that risk sits with the client. And that's because the NEC contracts do not seek to transfer all risk to the supply chain. And so the list of compensation events, those are all risks which are held by the client, and those will adjust the prices and adjust the timescale if those risks impact on defined cost or on planned completion or the remaining work, depending on how we're looking at things. So when pricing, the contractor needs to think carefully about what it is it's being asked to price. So it's not being asked to price the compensation events. It's not being asked also to price various other issues that may be left with the client. So look carefully at the scope, look carefully at the conditions, and do your matrix to analyse where risk is sitting with you and where you've got to price that. In terms of the fundamental obligation of the contractor, that the standard wording in the contract core clause is the contractor's got to provide the works. We'll look at that in a bit more detail. But the option F contract, which is the management contract, that has a slightly different wording, and it's probably the case, although it's not absolutely clear, that that reduces the level of risk which is sitting in there for the contractor. The contractor has probably still got significant risk in terms of its own prices, unless those are adjusted, and I'll say more about that when we get to that option. Next slide, please. So option A, this is the first of the options. So the contractor is under an obligation to complete the works for the prices unless the prices are adjusted. And so in that sense, we call this a lump sum contract. The prices are based on an activity schedule, which the contractor would have included in the contract data part 2, and is a document which the contractor has priced. And it is a document which should be provided by the contractor and produced by the contractor. And the reason why that is, if you look properly at the drafting of this contract, it's not a high-level pricing document. It's a very granular document. It's a document which shows how each activity on the schedule relates to the operations on each programme. And what we know from the programming, which we'll deal with in a later webinar is that the programming is very granular. It's the most detailed program of any construction contract in the market. And therefore, you simply, as a client, can't produce an activity schedule, which you might try and do as a tender stage, and that have any relevance to what's going to happen on an actual project, because it's the contractor who must relate their activity schedule in detail to the program. And in fact, if they fail to do so, the contractor will be required to correct the activity schedule. The payment mechanism is that the contractor is paid on completion of the activities. There's no percentage complete valuation going on, and clients sometimes try and group activities into a milestone structure. Again, I think that's somewhat misconceived, that there's nothing really in the contract that deals with the difficult problems that arise where that milestone isn't achieved because of problems caused which client risks. So I would certainly treat that with a great deal of caution. The activity schedule is not scope or site information, so it does not in any way limit the contractor's underlying obligation to carry out the works in accordance with the scope, and the site information will set the boundaries in terms of the physical conditions that they must price. If the activity schedule does not reflect the scope, then it can be and it must be adjusted, because otherwise we won't have a payment mechanism to pay against. But when it's adjusted, then it cannot redistribute the prices in a way that advantages the contractor, and it cannot change the total of the prices. So mistakes in the activity schedule are simply held by the contractor. Where, however, a compensation event impacts, then the activity schedule will be adjusted again by virtue of the adjustment. The value that we determined in the compensation event process will be introduced into the activity schedule, and that could either be redistributing activities, or it could be adding activities and prices. And in that context, the prices could go up or down, although it's the limited number of compensation events that can actually reduce the prices. In the Option A contract, we use what's called the short schedule of cost components. Again, we've got the same basic thing. What we're looking at is identifying the predicted defined cost and risk plus the fee to adjust the prices. And although risk isn't part of the schedule of cost components in the assessment of compensation events, it's clear that the contractor must allow for risk when you're looking at what you're predicting the impact will be in terms of defined cost. Next slide, please. Option B then is a remeasurement contract, and what the contractor has done is they've priced the bill of quantities. The responsibility for setting the method of measurement for that bill of quantities and the production of the bill of quantities is the responsibility of the client. What that means then is that in terms of remeasurement, that the client's taking the risk in relation to whether the bill of quantities accurately reflects the quantity of work shown in the context of the scope. And if there are any mistakes in the bill of quantities or departures from the method of measurement, or ambiguity or inconsistency between that document and other documents, then that has to be resolved by the project manager. And that's resolved in favour of the contractor on the basis that the contractors price the bill of quantities or the interpretation most favourable to the contractor. And the bill of quantities then has been produced by the client, and then the contractor will be paid on a remeasurement basis, by the quantities remeasured according to the rates in the bill as being priced, or where there are lump sums in the bill on the proportions of the lump sums. And we've got remeasurement then, again, where we have risk impacting compensation events, what we do is we will actually evaluate the change on a defined cost basis, which will look at predicting the impact in terms of resources and risk. But we will then transpose that evaluation into the bill of quantities as our payment mechanism, our adjusted prices or our adjusted rates. And so that's unusual. There is also an automatic trigger of a compensation event where the difference between the quantity of work done and the quantity in the bill is sufficiently great. And that's where the rate in the bill of quantity for the item multiplied by the final total quantity of work done is more than 0.5% of the total of the prices at the contract date. And so that's a kind of de minimis threshold. That's not a very high threshold, but that's only triggered, of course, if the contractor can show that there has been a difference in defined cost as a result of the quantity changing. So, as I say, compensation events use defined cost plus fee to evaluate the changes, and that's an important aspect. The schedule used in the contract for option B is the short schedule of cost components, and so we'll be looking at the underlying resources against that schedule plus the fee. Next slide, please. So the target contracts are both contracts where we have a target which starts with the supply chain pricing, either the bill of quantities or the activity schedule. And the adjustment of that target is exactly the same as in the option A and B contracts. It's a remeasurement target in option D, and it's a lump sum in option C. But both will be adjusted by compensation events and remeasurement in the case of option D. But instead of using the document as a way of paying, we pay the contractor forecast defined cost plus fee. And it's the amount that we are assessing the contractor would have paid in defined cost by the next assessment date. So we keep the contractor cash flow positive. So we're running essentially two accounts. We're adjusting the target through the compensation event and remeasurement mechanisms, and we are also paying defined cost as we go along. And we make a comparison between those two accounts, and the contractor will then get a share of any underspend or overspend as we see when we compare those two accounts. It's the contractor's share, which is set out usually in increments. The first assessment of that share is made at completion, and then there's another assessment made in the final assessment. And in this contract, we're using the full schedule of cost components to capture our resources. And also we've got the definition of disallowed costs now introduced. And so in the course of payment and over the course of the contract, we'll be managing the defined cost account and auditing that and potentially removing disallowed costs either as we go along or in the subsequent audits. Next slide, please. So option E is a cost reimbursable contract, and we would use this at the point where we really don't think we're in a position to go and get a price. That either be because we don't really know exactly what we want done yet. We could be at a very early stage of what might be a series of projects, and we're doing some early stage work. So we haven't really defined our scope. We're still getting there. So work not really subject to a kind of scope we could easily price, or likely to be subject to such extensive change that our pricing exercise would really be of little value to anyone, or simply that what we're asking someone to do they wouldn't really be prepared to take a kind of target or lump sum risk in relation to that because of the problems around deliverability. In terms of price risk, then what the contractor has to do is tender a fee, and then they get paid forecast defined costs plus the fee. So the contractor must understand what they're going to recover through defined cost and set the fee at the right level to capture the overhead profit or anything else which they're not recovering through defined costs. But otherwise, they are not exposed to much pricing risk, except for certain items in the schedule of cost components. There may be rates for, in which case those rates would have to be adequate for the purposes of delivering the content. And also there could be damages risk for late completion unless that's excluded. Next slide, please. The option F contract is slightly odd to have as a payment option because the reality is that there's not very much said about this in the standard drafting. All it says is that the contractor's going to be told by the client what work is to be subcontracted, and then it can then will have to price work which is not going to be subcontracted, and it will have overall responsibility for coordinating the subcontracted work and the work which it's carrying out and which it has priced. And the assumption is really that most of the work is probably being carried out by subcontractors. But again, that's a kind of assumption. It all depends on how a client sets up the scope. The instructions to tenderers would tell the contractor to price work which is to be carried out which is not subcontracted. And there's no real detail around that, although the suggestion is that it would probably be an activity schedule. And we don't have a definition of the prices. We have that wording in italics, prices there, which refers to the document which the contractor would include in the contract data part 2 as the document they produce. Assuming it is an activity schedule, then that each activity would have a price, and that's what they get paid on completion of that activity. But alongside that, the definition of defined costs, which is the basis for payment, is saying, well, they're going to get paid the prices for the work which they do and the amounts they pay to subcontractors for the work which is subcontracted. So there is a limit on the contractor's financial risk. It's only taking straight risk on the pricing. In terms of the subcontractors, that's largely sitting with the client in terms of the risk of changes to the subcontracts. And the problem, I suppose, with calling this a main payment option is that it doesn't go into very much detail about how this pricing document is arrived at or who's taking responsibility for the adequacy of it. And also when we are looking at the compensation event mechanism in this contract, it doesn't really say how those prices are going to be adjusted by virtue of the compensation events. So it's quite an unusual contract option. Next slide, please. So if we look at the general risk profile of these contracts, then the NEC suggests that the option A is the riskiest for the contractor in terms of pricing. But from a client's perspective, you must remember that actually the list of compensation events is very extensive. And this pricing profile, i.e. does more risk sit with the client or with the contractor, changes quite considerably amongst these options depending on what we're doing. So if an option F contract, the contractor's pricing a lot of that content, that could change in terms of that order. And similarly, in the C and D contracts, depending on the pain gain share, that would significantly change the risk profile for the contractor on how that's set. Next slide, please. So behind the pricing documents, then we need to think about what are you being asked to price. And in option A and C, the starting point is the obligation is the contractors to provide the works in accordance with the scope. And that definition, provide the works, is then given in the definitions section. It means do the work necessary to complete the works in accordance with the contract and all incidental works and services and actions which this contract requires. And if you read those two together, what you arrive at is that the contractor does the work necessary to complete the works in accordance with the contract and all incidental works and services and actions which this contract requires in accordance with the scope. So I think we still see the scope as being a limiting document in terms of the way that that's interpreted. The scope is produced by the client, and what we know about NEC contracts is that the scope's not just about what's to be constructed or the constraints on how it can be constructed, but there's a huge amount of the scope content, which is also about process in the contract and management of the contract. So the typical structure of the scope is about 28 sections, of which only about 4 are dealing with the permanent works as such, and the rest of them are dealing with process-related issues or secondary options or other content. So it's really important that the client and also the contractor fully review that to understand what it is that they're pricing. In options B and D, the contractor's not pricing the scope, they're pricing the bit of quantities. In an option E contract, that there is no pricing document, and in option F, the contractor's only pricing the work which it's been told to price. Next slide, please. So who prepares the pricing document? In options A and C, it's the contractor who's got to take responsibility for any inadequacy in the pricing document. That's clear. Again, if there are mistakes in that pricing document, if there was no relevant activity to cover certain operations or scope content, then that would have to be adjusted, that activity schedule, at no cost to the client. In options B and D, it's the client who takes responsibility. They select the method of measurement, and we see that there are compensation events around adjusting the bit of quantities if it departs from the methods of measurement, etc. So from a client's perspective, a properly prepared bill of quantities, it requires considerable expertise and some cost to the client, and it's the contractor who then prices that bill rather than the scope. Next slide, please. In the target contracts, what we're doing really is we are saying, well, risk that would otherwise be ring-fenced in the pricing document is now open to be managed, because what we're going to do is look at what's happened in terms of the costs we've incurred in delivering the project. And if we've improved, i.e. risk that was ring-fenced, has now been managed out, then the benefit of that can be shared. Similarly, risk that would have been, in a sense, sitting purely with the contractor, now can be also partly sitting with the client. The target contracts then are expensive to administer. They require to manage defined cost and also to do the target adjustments, a very large information exchange. And so from a client's perspective, when you're looking at target contracts, you're looking at what is the risk that would otherwise be sitting as a ring-fenced item in the price documents. Does it look as though there is the opportunity in the context of our project that we could see a potential benefit in going through a target position whereby we're able to manage or mitigate risk? And for certain types of sector, there are just certain risks where it's clear that it's really, really sensible to go down the target route, because otherwise the level of risk sitting in the pricing document is ridiculous, and it may not materialize, and therefore it's important for the client to really bring that into a more collaborative structure to manage that risk. So it's not not the purpose of target contracts to remove all the risk from the pricing, but to allow us the opportunity to manage or mitigate that risk in the course of the project. So the other aspect about target contracts is that the contractor must properly understand defined cost and disallowed cost and its fee, because that's the basis for payment as it goes through the project. So if it misunderstands that, if it sets the fee at the wrong level, or if it were to include rates in contract data part 2, which are not going to be subject to adjustment, they are the rates which are used to value in the context of adjustment, then they could catch a cold on that as well. So it's important to understand that. Next slide, please. So options E and F, no pricing document. Main thing is contractor must understand the relationship between defined cost and the fee, and they've got to be very clear about disallowed costs and manage costs properly, or they will lose out. In terms of the valuation of change, again, and also change risk generally, defined cost is usually open market or competitively tendered prices. So we're not forcing the contractor to price change in advance. And also, in certain circumstances, though, there can be rates again. So as a contractor, you would need to set your rates for your equipment and your rates for manufacture and design outside of working areas at the right level to cover you across the course of the contract, because there's no adjustment to the rates in contract data part 2. Option F, as we see, had prices, and therefore those will be what's paid unless adjusted by the compensation events. That there's no detail around that pricing document, and so I think there's probably quite a lot of further work to be done in an option F contract to structure things properly. And again, if you look at what it says about adjustment of the prices, it just says if we can't agree what the adjustment will be, then the project manager will assess it, but it doesn't give the basis for what that assessment would be, and therefore that's not really workable if you just leave that blank. Next slide, please. So what's not being priced and is therefore held by the client? So essentially the big items are the compensation events, poor scope, poor pricing in an option B or D document, impossibility. When we look at compensation events, we'll see failure to administer the contract on behalf of the client by the project manager. That all sits as client risk, and some other significant client risks. Next slide, please. So the list of compensation events in an NEC contract is extensive, and as we can see, it covers lots of the usual suspects like variations, so changes to scope, access problems, clients not providing things, or instructions to stop or not start work, but also failure by the client or others to work in accordance with how they've identified they would be working, either in the scope or through the programme. And also failures on the part of the project manager, i.e. not replying to communications, not responding to acceptances, not giving acceptances to contractor submissions, and other issues around that, or physical conditions, and also last on that slide, unforeseen events. So a lengthy slide there, but with a lot of risks sitting with the client. Next slide, please. And that list goes on to also cover further compensation events where we've got options B and D around the bill of quantities. And also there are secondary options which can also move risk to the client. So, for example, change in law, X2, that's a compensation event. And also under X15, where we've got the design responsibility with the contractor, if we limit that to reasonable skill and care, then correcting defects which are not due to negligence becomes potentially a client responsibility in terms of cost and time. So a lot there to think about when you're pricing, taking those things out of the equation, that those things sit with the client. Next slide, please. When you're looking at the schedule of cost components, to just remember, generally speaking, you'll have to demonstrate, you have to have your accounts and records in order. You'll have to demonstrate that essentially what you're seeking either are open market or competitively tendered prices, and showing all discounts, rebates and taxes, which you might be able to recover, unless there's a rate or percentage in the contract data which you've tendered at the tender stage. If that is the case, then of course you need to be clear that that rate or percentage is adequate to reimburse you across the life of the contract where that resource is being engaged. Also different schedules of cost components apply. So option A and B, it's the full schedule, the short schedule of cost components applies, and when it's C, D, and E, it's the full schedule. The big differences between them then is that option A and B have got people rates in the short schedule of cost components, where in the full schedule you're always having to demonstrate the underlying cost of people. There's pros and cons to that. The people rates, if you've got rates, are not going to be subject to adjustment. But it's hard work when you go into the full schedule, always justifying the underlying cost of people. So some clients prefer to go to a more rates-based approach on that. In option F, the problem is there's no real detail about how we're going to adjust prices for the contractor's work, so that needs to be dealt with. Next slide, please. So the choice of pricing mechanism has very significant impact on both behaviour and contract administration and cost. Option A is the most commonly chosen option, and that's simply because I think the industry likes activity schedules as a form of pricing document, and many clients want the contractor to take responsibility for that pricing risk. Option B, the odd thing about the NEC contract is that most bill of quantity style of contracts will use the bill of quantities as the starting point to value change. But the NEC contract doesn't do that. It uses the defined cost formula to value change, and then transposes that back into the bill of quantities. And that's actually a pretty complicated thing to do, and there's not a huge amount around the drafting for that, and so I think it requires expertise of quantity surveyor to be able to manage both defined cost and understand the nuances of bills of quantities, and that's not necessarily a skill set that all project managers have. And I think there's a more general reluctance too in the industry to use bills of quantities. Again, clients moving away from taking responsibility for that and also the upfront cost of it. And so option B is not that common, but you will see certain clients, who are very, very comfortable with bill of quantities. They know what they want to achieve, and they will drive that as an option, but it's not the most common. Target contracts are quite heavily used, and all I'd say about that is that thinking about how your target is priced and what risk it is that you're trying to manage out of the project is very important, and also just they are administratively burdensome. So again, there has to be a good reason for choosing a target option. Option E, similarly, often used as a stepping stone, to get us going or to do something before we move on to the point where perhaps we go to a more defined scope, or we've managed out risk that would otherwise make pricing very difficult. And option F we don't see this used that often, and where I have seen it referred to, in fact, what's really happening is a very bespoke structure, and the NEC is really being used as a bit of a coat hanger for something which is much, much more bespoke. Next slide, please. So apart from the choice of payment option, there are other possible ways of approaching pricing risk. So certainly if you've got a program of works coming up, you can separate contracts and use different options at different stages to manage risk out or start work. There's also a secondary option which allows for early contractor involvement, which the NEC has produced. That's for use with options C and E. And that gives us a two-stage process with the possibility of there being a break after stage one, allowing the supply chain to not proceed, or the client to proceed with another contractor if they wish to proceed with the project, or for the project simply not to proceed if in fact that was the conclusion of stage one. But again, a lot of drafting needing to be done to give the content for that. Also consider secondary options, pricing adjustment for inflation and change in law, but also remember there are certain risks which are not going to be captured by those kind of things. So price adjustment for inflation is just an index-based adjustment. Where we've got supply chain shocks and so on, then it may be you need to actually capture those as individual types of compensation event relating to difficulty in securing particular materials or supply chain resource. And there is an unforeseen events clause in the compensation event mechanism, which was being used for things like COVID, can also be used in the context of Brexit, and was also used for Ukraine, and will now potentially impact on projects which are being impacted by the risks around the current Middle East position. So a lot to think about when you are setting up your contract as the client, and similarly as the contractor when you're pricing them. Next slide, please. So you should have the detail of our further series. I just have a quick look in the chat and see if there's particular questions. So I think what I'll do is we're almost at time, and so unless somebody's raised a particular question that they want me to. So I think I've got one question. Under an NEC Option 8 contract, is it reasonable to apply for and to be paid for a percentage of an implemented compensation event value with an activity schedule, whilst keeping the original total of the prices unamended, especially if the compensation event is of significant value affecting most or all activities? I think that's something that should be thought about at the point where you're adjusting the activity schedule. And if you haven't concluded what the value of the compensation event will be, it seems to me you haven't concluded the process that brings it into the pricing document. If you have concluded that process, then it seems to me that what you need to be doing is looking carefully at where the defined cost is put into the particular operations or activities in the activity schedule. So as that aspect of the compensation event completes, you are capturing the value for that aspect of it which has completed. But that's something I think, if you've not concluded the position, that's probably part of the further discussion about how the compensation event will be implemented. If you have concluded it, it seems to me you may be stuck with however you structured that when you concluded that. So we're up to time now. So unless there are any other questions, then I will call this the end of the webinar. Our construction seminar series continues. Do have a look at the future events. I hope that was of use to you, and I look forward to seeing you on another occasion. So thank you very much on behalf of Irwin Mitchell.